So why is everyone from central bankers to your next-door neighbors suddenly talking about gold? I mean, with government debt going through the roof and inflation just kind of sticking around, figuring out gold's place in your portfolio has never been more important. But here's the thing. The strategy for a giant institution is totally different from the one that's going to work for you. Let's dig into why.
You know, this quote really nails the new way of thinking about gold. We're moving way beyond the old idea that gold is just some kind of panic button you hit when the markets go crazy. No, we're talking about it as a permanent, core part of a really well-built portfolio.
And the reasons for this shift are everywhere you look, right? We've got government debt at levels we've never seen before, interest rates that can't seem to keep up with inflation, and, yeah, a lot of geopolitical tension. Plus, and this is fascinating, central banks are buying up gold like crazy. These aren't just little trends, these are major long-term shifts in how the world economy works.
All right, so here's our game plan for today. We're going to look at why gold is more than just a hedge. We'll compare the two very different worlds of investing, dive into the institutional playbook, and then break down the guide for individual investors like you and me. And finally, we'll try to help you figure out what your optimal number might be.
Okay, first up, gold beyond the hedge. Let's get into why it's now seen as a crucial building block for pretty much any modern portfolio.
You always hear that gold is this amazing inflation hedge, right? Well, looking at the history, it's a little more complicated than that. Back in the 1970s, wow, it was incredible. But then in the 80s, not so much. So what this tells us is that in the short run, gold's performance can be, well, a little all over the place.
And this slide right here explains why. The data shows that the connection between gold and inflation over, say, a 5-year window is pretty weak. But when you zoom out and look at a 20-year timeline, that connection gets way, way stronger. So the big takeaway here is this. Gold is not a short-term trading gadget. It's a long-term strategic asset for protecting your purchasing power over time.
Which brings us to this really important idea. There are two completely different worlds of investing. You've got the giant institutions, and then you've got individuals. They have totally different goals, which means, you guessed it, they need totally different playbooks.
Just look at the difference here. On the left, you've got the institutions. They're thinking about preserving insane amounts of money, making sure they can always access cash, and hedging against massive global events. I mean, they're literally in the business of storing a nation's wealth. Now, look at the right. That's us. Our goals are a bit more personal, right? We want to hedge against inflation, diversify our nest egg, and get good, long-term returns without taking on wild risks.
So let's dive into that institutional playbook first. Let's see how the biggest financial players on the planet go about building what's basically a financial fortress.
This survey is pretty revealing. You can see that, yeah, most institutional managers have some gold, but it's definitely not their number one asset. Almost all of them hold government bonds and cash. For these massive players, gold is just one piece of the puzzle. And honestly, how much they hold can have as much to do with history or politics as it does with pure financial strategy.
And when they do decide how much to hold, their math is, well, it's incredibly complex. Now, don't worry about trying to understand this whole chart. The only thing you need to know is this. For an institution, there's no single magic number for gold. It's all based on super complex models that are designed to protect them from the absolute worst-case scenarios. They're not just picking a number, they are stress testing their entire fortress.
And here's what that fortress actually looks like. Check out Portfolio 1. Which represents a typical conservative central bank. A mind-boggling 95% is in U.S. Treasuries. This is not a portfolio that's designed to shoot the lights out with growth. It is built for one thing and one thing only, ultimate unshakable stability.
So let's just sum it up. For an institution, the game is defense, period. Getting the highest return possible is a very distant second to making sure they have cash on hand and can survive a catastrophic global event. Gold is simply one tool in that defensive arsenal.
Okay, so that's the fortress. Now let's completely switch gears and open up the individual investor's guide. Because for you, the game is totally different. It's all about finding that perfect balance between growth and safety.
For an individual investor, gold actually wears 4 different hats. First, it diversifies, because it often zigs when stocks and bonds zag. Second, it's a hedge. It acts like a shock absorber when things get bumpy. Third, it's a timeless store of value. And fourth, and this is important, it can also be a source of growth with really solid long-term returns. It's both offense and defense.
And the numbers here really make that case. Sure, a stock index delivered higher returns, but just look at gold's performance.
Whether you look at a 5, 7, or 10-year period, it has consistently delivered over 8% per year. That's some seriously steady, reliable performance that adds a really powerful layer of stability to a portfolio that's also aiming for growth.
Okay, so we get to the million-dollar question. How much should you actually own? Well, the most common starting point you'll hear from financial experts is somewhere in the 5 to 10% range. This is often seen as the sweet spot for getting those diversification benefits without giving up too much of the potential growth from your stocks. But if you're maybe a little more worried about risk or inflation, or you just want a stronger shock absorber for your portfolio, some respected firms suggest bumping that up to the 10 to 15% range. This is for someone who really wants to put a bit more emphasis on stability.
And now for a number that might surprise you. One really deep analysis that looked back at 50 years of market data actually found that the quote-unquote optimal allocation, the one that gave the best returns for the amount of risk taken, was actually 18%. So what that shows is that history supports a potentially much larger role for gold than a lot of people might think.
So all of this brings us to the final and most important question. What is your optimal number? Because as we've seen, the right answer really depends entirely on your personal goals. Let's just quickly recap the big points. Institutions, they play defense. Individuals, we have to play both offense and defense. Your right percentage is a personal choice based on your own risk tolerance and goals. Remember the trade-off. More gold means more stability, but it could mean less growth. And finally, the most important strategy. Gold is a permanent holding, not a short-term trade.
And look, if you only take one single thing away from this whole explainer, please let it be this. Your personal financial strategy needs to be designed for your life and your goals, not to copy the playbook of some giant institution that's playing a completely different game.
So, I'll just leave you with this one question to chew on. When you look at your own portfolio, is it built like an impenetrable fortress, or is it designed to be a dynamic balancer of both risk and reward?
If you do want to learn more about how you can incorporate gold specifically into your own retirement strategy, you can explore the free Gold IRA guide that we've linked for you in the description below. Thanks so much for tuning in.